Welcome and a very good morning. We have an interesting agenda for you this morning, UOB Asset Management's 2024 Annual Investment Outlook. A lot to cover in 1.5 hours, and it has been a very challenging year in 2023, 2 years including 2022, but we see light at the end of the tunnel, a number of interesting opportunities in 2024. And to kick things off, we have Chong Jiun Yeh, Group Chief Investment Officer, for the opening and welcome address. Jiun Yeh?
Thank you, Peng Yu. Good morning to all. Well, thanks for joining the webinar 2024 Annual Outlook. We hope by the end of this webinar, all of you would have a clear investment strategy in the year ahead. But at the start of 2023, market was facing two key issues. First, hard landing versus soft landing. Second, whether inflation would improve with or without recession. And we at UOBAM has always argued that inflation would improve, and we didn't think a recession was likely in 2023. And this was largely vindicated by the end of this year, but of course with periods of uncertainties and volatility along the way. And with this, let me pass back to Peng Yu to bring us to the next agenda item.
Thanks, Jiun Yeh. Yes, we do see interesting opportunities on the horizon. Now, to frame the big picture, how it looks for markets, we have Tony Raza, Head of Multi-Strategy, for our 2024 Global as well as Asia Outlook. Over to you, Tony.
Thanks, Peng Yu, and good morning, everyone. So we think 2024 is shaping up to be an interesting year. So let me go ahead and share the framework that we have for our outlook in 24. So to start with, we would look at this as being our outlook for both global and Asia. And we have some key themes that we're highlighting to a lot of our clients as we're starting the year. So the first one, it's that, we think the Fed and the ECB are done. And that's going to be, a big change compared to what we've been dealing with in the last couple of years. But we still think yields are going to be relevant. And this whole higher for longer theme is really what's going to be driving yields as opposed to central bank actions. And, in this the course of the day, we have a panel and we have more thoughts on how we go about thinking about higher for longer, what it means to us, and how we think it's going to affect markets in the coming decade. A second sort of just takeaway from that whole Fed is done point, we don't see any more rate hikes and we see rate cuts. We anticipate 2 rate cuts in the coming year, which is turning out to be a little conservative versus what the market's pricing nowadays. I think the market's pricing up to 5 rate cuts in 2024. I'll explain why, our views get to only 2 rate cuts. It's partly due to a better economic outlook than I think many have, and also just being cognizant that it's a presidential cycle and we really should be bracing for the Fed to try to be quieter and less relevant in 2024. Another big theme that we really think is going to sink in with the investor mindset around the world is, I think it's going to become clear that the hard part is over. That the last couple of years we've been dealing with high inflation, central bank rate hikes, hard landing risks, and all of that is really easing as far as being a real headwind in terms of investing. And so we would argue that things look a lot more comfortable and a lot more normal for the investing environment. And instead of looking at central banks and inflation, I think we're just going to be looking at earnings growth and how strong or lackluster it is. And we'll be looking at yields and whether or not that's attractive enough. But I think it becomes a lot more straightforward investing in 24. And then when it comes to it for 24, we would go out and say that, based on the economic trends we're seeing, we don't see a recession in the next 12 months. We would say that it's fair enough to call a lot of the characteristics of the current economic cycle to be sort of very mature cycle, very late cycle. But the momentum we have right now usually just doesn't add up to an immediate recession. I would say it would take a couple more years before we really get there. And then a final key theme that I think is going to be really important for this year is we see better breadth in the global economy. I would argue that in 2023, a lot of sectors like global trade, global manufacturing, were all very weak. And it was really just services and kind of developed market services that were really just holding things up. And it would be a lot healthier for markets if we saw better economic breadth. So those are our big sort of macroeconomic views. Let me just share some of the biggest investment implications of all this. So one, the better economic breadth, both sort of within the various sectors and the geographies, I think this is going to add up to better breadth in equity markets and amongst asset classes. So within equity markets, we would highlight that, in 2023, equities have done well. Global equities are up like 17%. US equities are up like 20%. But if you took out like the Magnificent Seven, the US market is hardly up at all. And really, when you look by geographies, the US was holding things up quite a lot also. So I think, better economic breadth is going to lead to better market breadth. I think the rebound in manufacturing and trade is going to be really important for having more sectors drive earnings. And I think that'll be a key theme for investing in 2024. Second key theme, I would just say, is that we see broad asset classes doing well. So both stocks and bonds look attractive to us. For stocks, we would anticipate something around an 8 to 10% type return. That would be in line with the earnings growth that we're seeing. For bonds, we just think yields will carry their returns. And, when we look at a lot of the corporate bonds we're investing in, we see 5 to 6% type yields, and we think that's the type of return you're going to get over the coming year. So I'll show our overweights and underweights, but that kind of leads us with a view that stocks do a bit better, but bonds are doing really attractive as well on a risk-return basis. On a geographic basis, we've been overweight the U.S. for a while, but as we start the year, we're a bit more neutral on the U.S., and we expect Asia and Japan to be the outperformers in the coming year. I'll go through some of the background in this presentation, why we get those overweights. And then finally, I just see broad asset class performance in credit and high yield looking pretty good. And a lot of the commodities, particularly gold, energy, and industrial metals, all look like they're in really good position for this year. Okay, so in our quarterly investment strategy, we usually pencil in very sort of detailed breakdowns of exactly which regions, which sectors, what type of investments we're overweighting and underweighting. I won't go through it all here, but as I mentioned, broadly, we're overweight equities. We're neutral fixed income, but I would call this, a positive neutral. We think the outlook looks good, but we see equities as being a bit higher. And then on a geographic basis, as we mentioned, kind of downgraded US to a neutral, and we're higher in Japan, emerging markets, and Asia ex-Japan. Okay, so I have some comments on what we're seeing in the economic cycle and how we get these fairly constructive views for 2024. And then I have some thoughts on higher for longer to introduce, our next topic in this presentation this morning. So firstly, on the economic cycle, I think we've had various tools to sort of graphically illustrate where we think the overall economic and investment cycle is. We usually use an investment clock, but the clock is kind of confusing given the patterns that we've been seeing. So I just try to highlight to clients that, I would just look at things, this whole investment cycle in sort of a traditional wave diagram. And obviously we had, our recession in the midst of COVID back in 2020. We had the recovery, and in 2021, by the end of it, things were looking a bit hot. And then in 2022, things started to slow down. As we entered 2023, there was a lot of anxiety that these areas of slowdown could trigger and fall all the way into a recession. I think, if you recall, anyone who was joined us at this time last year, we were arguing that we're sympathetic that we understand where a lot of economists were coming from. They were seeing leading indicators turn negative. They were seeing an inverted yield curve. And they were seeing inflation at a level that it looked like the central banks were going to have to create a recession in order to get it under control. But we were arguing that, COVID was skewing the analysis here and was making a lot of the traditional analysis less clear. And if you actually tracked businesses, what they were saying, especially in the service sectors, they were saying that they haven't even got back to normal operations yet. They were saying that they needed still more workers to have a minimum level of operations. And this is different than like the peaking of a normal cycle, where the traditional comment would be something more along the lines of, we saw really strong growth, we hired a lot, but things look like they're slowing down. We might have to lay off workers. And that's how a recession really kicks off. As workers lose their jobs, they have less spending money. That means businesses have to lay off more workers, and et cetera, and you're in the midst of a recession. We were highlighting, we're seeing so many characteristics that just weren't matching the traditional profile. And we were arguing for sort of a continued expansion or a very shallow recession, if there's one at all. And I think this is the way I would sort of, mentally think about this cycle. We've gotten an extended cycle. And what's happening right now is your service sectors and manufacturing sectors both look like they're going to be on track this year, and you're going to have just a continued expansion. It is late cycle. Eventually, you'll get a recession, but based on the trends we see, we would say it's at least 12 months out, and it might be more of a 25, 26 issue. When it comes to the economic growth, this is just a breakdown of what consensus economists are forecasting, and what I'd highlight is at the beginning of the year for 2023. The vast majority of economists had negative numbers for U.S., Europe, and Japan, and obviously it turned out to be a fairly okay year. And the numbers aren't necessarily strong for U.S., Europe, and Japan, but I see economists aren't really willing to call a recession quite like they were last year. And I think maybe these numbers in the end, maybe they're a little conservative, but I think the main theme is probably right, that I don't think this is a real sort of overheated, really hot economy, but I don't think it's a recessionary economy. So I think that makes it a fairly comfortable backdrop as we think about, where to do investments. This chart here, you can see the blue line is just tracking goods spending, and this orange line is tracking service spending. And I think we all know this story quite personally, right? In the midst of COVID, we all stayed home and we ordered lots of goods on Amazon, and hence you can see this blue line was doing really well during the COVID period. And then we have, and services obviously were doing really bad because we couldn't go to restaurants and we couldn't go travel and take flights or stay in hotels or anything. But then at the end of COVID, what you saw was that services really kicked in and stayed high really for the last couple of years, where goods fell to negative levels. And, if you look at the goods sector and you look at manufacturing and you look at global trade, that all kind of looks like it was in a recession last year. But services make up like 70 to 80% of the developed market economies, and those were doing well. And hence you have the overall economy staying positive. And I think what's happening right now is interesting. And, this is this whole point of better breadth in the macro environment this year, is that the goods sectors in the last few months have been picking up, and they're starting to expand just like the service sector. And, if you look at the macroeconomic trends, we really, are careful to track manufacturing because we think it's, highly influential, especially for the stock market. For the listed companies in the stock markets around the world, they're more tied to manufacturing. They're more tied to the goods producing sectors. Things like restaurants aren't usually listed. And therefore, we kind of need to see, for earnings growth, to see this manufacturing pick up. And so, in Europe, we're starting to see the PMIs pick up a little bit. In the US, we've been tracking these regional PMIs. And the black line is the summary of averaging them all. And what we are, and while there's a lot of noise here, we're starting to see that this average is getting close to being expansionary again. And if this trend continues, then that's, the heart of our view that, hey, this is a broader economy, and broader economies going to do better for corporate earnings and for stock indices and for breadth of stocks. And we won't have to count on the Magnificent Seven to drive everything. The main takeaway then is in earnings. As I mentioned, in the past year, what you had was the economy doing well because of the services. But if you see this earnings growth in 2023, it was really quite pedestrian. And that's because of the lack of sort of, just broader manufacturing and so forth also kicking in. But in 2024, what analysts are seeing is just a better earnings environment. We're getting sort of double-digit earnings growth in US, Asia, and China, and in Europe and Japan, it's sort of mid to high single digit. And, so we spend a lot of time analyzing these trends, and we kind of like what we're seeing. We kind of think there's a good likelihood that this can come through. And if this comes through, I think this becomes the basis on what to expect in equities in 2024. So, we, as I mentioned, we're kind of more neutral to the US. We would say this probably ends up maybe 8 to 10%. And Asia and Japan, we kind of think the growth looks a bit better here. And especially if trade rebounds, then Japan tends to be leveraged into that. And we think these numbers hold up quite well. And then I think, the inflation was like the key story last year. When I started this presentation last year, I went on about inflation and why I didn't think we had to be overly alarmist about inflation. And I think that's largely been borne out. And I don't necessarily think I have to explain it as much this year, but our view is that these trends are continuing. On the left-hand side, if you look at core inflation, on blue line is a 3-month basis. The red line is the 6-month basis. They're kind of coming down to the sort of low to mid 3 level. And when you actually look at the inflation numbers, what we like is that the sort of core elements of goods inflation and service inflation are adding up to a fairly good number that's pretty close to 2%. The main thing that's sort of keeping it up is rental inflation. But if you check the rental markets, they're going in the right direction. If you speak to real estate agents in the US, they don't say rents are going up. And therefore, if this blue line comes down, then these overall numbers should get more and more comfortable. And I guess, it leads to the commentary that we've been getting from central banks in Europe and the US, where the central bankers are feeling much more comfortable now. And then I guess just lastly, we would argue that this spells the end of rate hikes, and that implies roughly about 2 interest rate cuts. This comes from our modeling. These would be some of the key policy tools central banks use. This would be things like a Taylor rule. And based on some of the key underlying assumptions, it implies that you don't need more rate hikes, and implies that it should come down by a couple of cuts. The market's assuming more, but we think that's largely because I think the market is assuming a weaker economy, and that the Fed may start to feel like sort of recessionary conditions and therefore start cutting. So I think the market might be getting a bit ahead of itself. But either way, I'd say it's somewhat similar story, that the rate hikes are over and that it's just a matter of how many cuts in the coming year. So that's the broad economic backdrop. As I mentioned, I think it's a much more clear environment. We don't have all those negative overhangs that we've had in the last couple of years. And as we would argue, the hard part's over. We're back to normal investing, and that things look a lot more straightforward from here. Which then brings us to what I think is sort of a bigger multi-year story. And this whole theme of higher for longer, I suspect everyone's been hearing about it and seen various presentations on it, but everyone talks about it a little bit differently. And I wanted to explain some of the key elements that we think is important, because I think this is a theme that isn't just about this year. I think it's about the years to come, really for the coming decade. So here's some just key points we usually highlight. So I see a lot of market commentators use this term to imply that inflation, those who are negative on inflation, to say that it wouldn't come down. They were using this higher for longer. But we're using higher for longer, and we thought inflation is coming down. We're referring to something else that I'll explain. And some people used it to say that the Fed won't cut interest rates and that they're going to keep raising interest rates. And again, that was sort of very short-term thinking. That's not what we're really talking about. We're talking about decade regime change. So for us, what it means is that inflation and interest rates in this will enter a new regime, and they'll have broad implications for the next decade. We would highlight that the last decade was a unique period of very low inflation, and that there's a lot of reasons to believe that this low inflation regime is over, and that the asset classes are therefore going to behave differently in this coming decade. And I think we all need to, start thinking about the implications of that. One of the market implications in the last decade of having very low inflation and having very low interest rates is it created an investment environment that we and I think some others would call TINA. That is, it would stand for there is no alternative to equities. That is, interest rates would be zero, and it was just forcing everyone to take on risk and buy equities as the only thing that had positive returns. We would say that period is largely ending. We're entering a period that we would call TARA. There are reasonable alternatives, and that they're back, and that we need to think differently about our investing now. Ultimately, higher for longer on an economic basis sort of implies inflation is structurally higher, but ultimately an investment implication and the real ending result is more just interest rates will be higher than we've seen in the last decade. Sort of a chart I like to use to explain higher for longer and to explain the various regimes that we've been in for the last multiple decades. So it would be a chart like this. In this chart, the red line is the Fed funds rate, and the blue line is the inflation rate. And what you can see is that historically, through most periods before the financial crisis in 2008, the central banks were worried about inflation being too high. And during some periods when inflation was kind of very high and out of control, then interest rates were very high. But other periods, like such as the 90s and the 2000s, when inflation was, a little bit high, but not really out of control, then you had interest rates that were kind of more moderate, but staying above this blue line. And then in the last decade, this is the period where inflation was having trouble hitting the 2% target, and interest rates were kept at 0%. Essentially, this is when the red line's below the blue line, the Fed is trying to push inflation up. And when the red line is above the blue line, the Fed is trying to push inflation down. And so I'd say the biggest thing for us, if I was to graphically explain higher for longer, is this period is ended. The red line is no longer going to be below the blue line. We're getting back to a period where the red line is above the blue line. And then the question is, well, is it going to be like a 1970s environment or maybe like this 90s, 2000 environment? We would argue that we see a lot more evidence that it's looking more like this 90s, 2000. Inflation doesn't look as much runaway as it did in the 70s. But to us, I guess that the broad backdrop is the biggest sort of discussion that we would like to have with clients about higher for longer. The reasons for expecting this change are multifold. You've probably heard a lot of these points before, but just quickly, the first point that we would just highlight is that the financial crisis in 2008 necessitated a lot of deleveraging, and the deleveraging that went on for really almost a decade sort of led to subpar economic growth and lackluster growth that didn't really ever trigger inflation to higher levels. So that's one key element that looks like it's over. If you look at things like loan growth in the developed markets, it looks stronger and healthier than we've seen in a while. And so that impulse looks like it's ended. Another issue, of course, is the end of globalization. Globalization led to a lot of price efficiency gains, but a lot of that's being reversed now, and therefore that becomes no longer a tailwind on pricing, becomes a little bit of a headwind. Climate change is also a key new issue that requires a lot of new investments, and all these new investments do contribute to pricing and inflationary pressures. Then the final one we just highlight on our list is that the peace dividend is over. Conflicts between US and Russia and China and the Middle East are all more significant than we've had in the last couple of decades. And therefore that whole peace dividend is likely over. So those are some of the main drivers of why we think things are changing. A couple of key things that we think investors get wrong about higher for longer is a lot of clients, as we speak to them, kind of make the assumption that if we're saying inflation is going to be higher, I think they immediately start thinking about the problematic inflation periods of like the 1970s. And that's not really the regime that we really expect. We expect it to be more like the higher inflation that we had in the 90s and 2000s. And that's important because markets broadly did really well in the 90s and 2000s, and they broadly did pretty poorly in the 1970s. So I think, context is important. When we speak about higher for longer, I don't think it has to be a negative thing like I think many investors sort of immediately take away. As a matter of fact, I would argue inflation is sort of a byproduct of more vibrant economies. And, the economies of the last decade, that was, very subpar, very stagnant growth for a decade. That is not very exciting and doesn't lead to inflation, but isn't really the best economic environment. And of course, on the other extreme, Japan, with its periods of deflation, was a very weak economic environment, and it was very weak for equities. And so therefore, I think returning to a more normal inflation and a higher for longer period actually has positive context, and not only the negative context that a lot of people jump at. And then the other big theme that I get into a lot of conversations with clients, and I think they've been lulled into sort of a false comfort and safety of cash. And that I think they've looked at markets in 2022 and 2023 and felt like it wasn't really worth investing. In 2023, actually, both stocks and bonds are beating cash, but it was a volatile year. So I kind of understand where that thought comes from. But as we enter 2024, I think things look more steady. I think the investment climate becomes easier and less risky, and I think stocks and bonds continue to beat cash, and I think there's a reinvestment risk because we're late cycle, and when the recession does come, that means your rates are going to disappear, and therefore you're left with nothing at that point. Whereas if you buy bonds, you're going to have that for the length of its tenure, even if there is a recession. In fact, you'll make better gains. Just a quick chart, we talk about these regimes. I would argue that, investments in the 70s really weren't very attractive. Maybe commodities and gold did well, but that was kind of like the only thing. And then I would argue that in the disinflationary period of the last decade, it wasn't bad for markets, but a lot of these numbers are kind of a little lackluster. Whereas I'd say the most healthy numbers for equities and bonds was really kind of more this higher inflation period of the 90s and 2000, and that's the regime we think we're shifting towards. And a final comment on cash, I keep seeing investors saying they like FD rates. So we took the average of FD rates from January to November, and they're kind of getting about 3.5% return. And just highlighting that, all the global benchmarks really pretty much are beating that. I think they were a bit lower in October, but by the end of November, they're back ahead. And then global equities have done great, nearly 17%, US equities nearly 20%. So, I think it's been a year where we should recognize that asset classes are doing well. So I guess in conclusion, we have, our broad macro views that we think the hard part is over. We think central banks are done. And we think that we're going to get better breadth. That's going to lead to an environment where both global stocks and bonds do well. On a medium-term implication, we like equity alternatives. We like high yield, which have very attractive yields right now, and we like selected emerging market local currency bonds. We expect growth stocks to outperform, and we consider commodities a good diversifier at a late stage cycle like now. And then I usually hit on a lot of questions that we typically get asked. And so just to conclude on this, so one question I get asked all the time is, when's the right time to rotate out of cash? It's been, offering nice, steady, safe returns for the last year plus. And I am telling clients, I think the time's already. Stocks and bonds beat cash in 23, and 23 was still volatile, but the hard part's over. The inflation threat's diminishing, rate hikes are done, and rate cuts are coming in 24. And if the cuts are going to probably lead to lower rates, fixed deposit rates, and so forth. And so therefore, in the 90s and 2000, fixed deposit rates were 4% also. But nobody spent all their time huddled in fixed deposits. There were lots of opportunities, and I would encourage investors seeking higher returns that there will be those opportunities. I also get asked this question as we talk about higher for longer, that, hey, interest rates look like they peaked in 2023, and now we're talking about rate cuts. Why are you still talking about higher for longer? And, goes back to this point I was trying to make earlier. I think some people were referring to higher for longer just meaning that the Fed was going to have high rates for a couple of years. That's not the way that's not the message that we think is important to describe. What we think is important to describe is that we're entering a new inflation regime, and that implies a new interest rate regime, and that the average interest rate in the next decade is going to look much different than the past decade. Another question we get asked quite a lot, and it goes like this, that, in 2023, something like 70% of the world's economists were predicting a recession. And why were so many wrong? And, if I can't trust the forecast, even at UOB, maybe we got that call a bit more right. But, to any normal investor out there, how can you trust, people speaking like myself or anyone? And my answer would be that, for the most part, we have a lot of tools to understand where the economic cycle is going. And I think what happened in 2023 is that there was still the remnants of COVID really sort of skewing the economic patterns and the way we were seeing things. And I think we're emerging out of that. I think I showed the chart on the economic cycle and how things are getting back in line. Services and goods are all sort of behaving more as normal. And therefore, I think the data, as we look at it, I think is becoming, more clear and kind of more historically accurate. And therefore, I think the takeaways are going to be more useful. So I'm sympathetic to anyone who's frustrated listening to talking heads like myself. But I would say, actually, I found the last couple of years confusing in the midst of COVID, but I think things are looking clear, and I'm having more confidence, and I'd like to express that to the clients. And then a last question. A key call we had at the start of last year was that we thought Asian equities should have a good year, and that did not pan out. And here I am at the start of this year, and I have Asia as one of our top overweights again. And I just want to recognize we did feel wrong-footed in 2023. We were expecting a China reopening to be a big economic driver for Asia as a whole and for the global economy. And, our team, and especially like our bottom-up analysts that were tracking these China stocks, they started to report to us in February last year that, hey, our call on Asia our call on China is not panning out, and that we started to back off from it. I would say that as we look at things right now, our view is that China still looks like it needs more time to get over a lot of the issues it's dealing with. But in terms of its cyclical weakness, it does look like it's steadying a little bit. And if so, then that's about all we need, because we like what we're seeing in the rest of Asia. As long as China doesn't drag down the rest of Asia, what we see is that global trade is picking up. We see that the US dollar has peaked. We see interest rates have peaked, and that all of this creates a better backdrop for investing in Asia and for Asian growth. And Asia has underperformed for several years, and its valuations are better. And so as we add up all this, and we're expecting our better breadth, and we're looking where the strongest earnings growth is, and we're getting Asia. So it didn't work out for us last year, and but I would highlight there's still a lot of things to highlight for this year. Okay, so those are our main points for this year. I'll stop there and I'll turn it back to you, Benyu.
Thank you, Tony. Well, 2023 may not have been such a bad year after all, right? Global equities did well. US equities did very well. Asia, maybe not so much. But definitely in this higher for longer era, we do see more opportunities in 2024. Now, to bring it all together, we have a panel to discuss these new investment strategies. We'll have Jiun Yeh moderating, and joining Tony as speakers, we have Loh Han Seng, Deputy Chief Investment Officer, Paul Ho, Senior Director, Asian Equities, Chu Chien, Director, Macro and Multi-Asset Strategy. Okay, Jiun Yeh, take it away.
Thanks, Benyu. Okay, let me set the stage for our panel discussion. Tony just now have delved into some of this structural thing. What we have seen from the last decade of lower for longer, this inflationary environment, zero interest rate or negative interest rate environment is actually moving to higher for longer regime for the rest of this decade. So one of the key change in this environment, this change of the regime is from QEs, money printing by all the central banks in the developed world, to QTs, quantitative tightening by a lot of the central bank, especially in the developed world. So some of the structural reason for this is liquidities from free money, from quantitative easing is over. Debt-related problem, the dollarization has begun, on the back of the geopolitical risk, the modern-day Cold War, the ESG and climate crisis, concern. As you see our arrow in between the stagflation and the normal inflation with the investment clock, what we're trying to say is that it's probably not the worst that we have seen in the 70s with a very stagflationary kind of environment, but it's probably not your normal inflationary kind of investment clock. So it's probably going to fall in between, this higher for longer regime for 2020s, for the next 5 to 7 years at least. And what is the outcome? Liquidities in most of the financial markets will continue to be reduced. Rates will remain high, inflation remains sticky, and one of the outcome will be is that growth will be moderating in many parts of the world, especially in the developed economies. I think with that, Tony, given this change in the regime, what does higher for longer means for global equities? What investment strategy that we should adopt?
Okay, so I think, as I mentioned in the presentation, one of the broad things are just that equities tend to be a natural inflation hedge, as earnings that equities get are nominal in nature, and therefore as inflation goes up, the earnings go up along with it. And as I mentioned, equities might have done poorly like in the 70s, but in the 90s and 2000, equities have done well. And then when it comes to the types of equities we like, we usually highlight that we like equities that have broad pricing power. Those are the ones that really, when there is inflation, they can ratchet up their prices and pass on that inflation to consumers, and they can maintain their margins. And so typical sectors usually would include things like consumer staples, and usually includes things like healthcare and energy. And then we also like sectors that are exposed to real assets. So this would usually include real estate, and would include things like REITs, in which have real assets as their underlying assets, and their dividends would be, or their rents and dividends would increase. And then also things like commodities in general tend to be formed. The stocks that are tied to mining and minerals and other commodities tend to do well.
Okay, thanks, Tony. Wow, over to you, Chen. What does higher for longer means for investment grade or high yield bonds, and also in terms of how durations profile of a fixed income portfolio?
Thanks, Jiun Yeh, for the question. In short, higher for longer means that investors now have actually a higher base rate to work with. In short, the cash rates are easily around 4% at this time. And going forward from here, I think in a scenario whereby growth holds up, so without recession, then in this scenario, I think high yield, investment grade, also the emerging market, local currency space, these will all do fairly well in an environment as, restrictive policy rates probably would not derail the global recovery from here. So I think this is our house view, and that would favor these segments of the fixed income markets. On the other hand, for example, if we do see that the growth starts to falter or deteriorate, I think from fixed income investing perspective, we do have the ability to move towards the longer duration bonds, and this would do pretty well. I mean, 50 basis points, 100 basis points rally would be fairly significant, and certainly will easily outperform the cash rates from here. So in short, I think high for longer is actually good for investors, as they are able to kind of be able to move between some of these segments of the fixed income market to get even higher returns than 4%. Yeah, so in here, this chart shows you that in 22, certainly across the fixed income space, it was a negative returns, double-digit negative. But already going into 23, you already see, for example, the high yield returning almost about 9%, and emerging market local currency bonds also returning about 8% thereabouts. Going forward, on a medium-term basis, we do expect these segments to continue to hold up, so long as the growth backdrop remains benign and healthy.
Okay, good. Thanks. Maybe now, I can move over to Asia and to Paul. Paul, what does higher for longer mean specifically for Asian and ASEAN economies and also the equity markets?
Yes, Jiun Yeh, thanks. Well, if the higher for longer scenario, if we assume that it's going to be caused by higher inflations over the longer term, and if one of the major contributor to that is going to be commodity prices, then I think commodity exporters in ASEAN, such as in Indonesia or Malaysia, would tend to benefit. And that will most likely translate also into higher income for consumers, and hence benefiting consumer companies in this region, right? Now, conversely, all else being equal, China is a net importer of commodities and energy. And this would mean just a little bit higher inflationary pressure in the country over the longer term. Now, but one saving grace with China is that with their investment in automation and the likes of AI, productivity gains might more than offset this raw material price increase, which means selective manufacturing companies may still do well, right? And also as wages of Chinese workers increase, we think that will again be beneficial for consumer companies over the longer term. So that is definitely also in line with our long-term view of China, where the government is encouraging consumption or trying to increase consumption as a percentage of their GDP over time. Now, in contrast with the rest of the world, however, we do think that we are not so likely to see a higher for longer environment in China, right? Instead, we think that we are likely to see loose monetary liquidity conditions in China in the near term. Now, especially as it deals with all this, Chinese real estate situation, the debt situation, and we believe, yes, liquidity overseas might tighten, as you've pointed out, Jiun Yeh, and that will certainly affect certain groups of companies that have been, raising money offshore. However, we believe that increasingly many of these companies will also turn onshore for their financing needs because of the unfavorable external environment. Yes.
Okay, thanks, Paul. Well,
thank you.
Finally, moving to Hang Seng. Okay, is there a need to consider less conventional assets against this new higher for longer era, and what should investor consider?
Thanks, Jiun Yeh. Well, if you like free gifts, and really who doesn't, you should really consider including more uncorrelated assets classes into your portfolio. As Nobel-winning pioneer of modern portfolio theory, Harry Markowitz famously said, diversification is the only free lunch in investing. So we would generally recommend that our investors allocate a certain percentage of their portfolio into less conventional asset classes, commonly known as alternative investments, for diversification purposes. This is even, I think, more critical in the current environment. As Jiun Yeh has mentioned, there are a lot of things changing. There's the interplay between liquidity rates, inflation, and growth moderation. And I think diversification gives the portfolio some level of stability. I mean, as we have seen in 2022, the diversification between equity and fixed income didn't quite work out as planned, and both asset classes declined in excess of 16%. And even in this year, we've seen the correlation between these two asset classes come close. So I think in this environment of transition and the regime changes and many interplay, as we do a regime transition, it makes a lot of sense really to diversify into unquoted asset classes. Now, when you look at these unquoted asset classes or alternative investments, they do cover a wide range of assets. And the two that we would recommend looking at today, within the context of this whole multiple macro states that we had introduced in our paper, it would be gold and absolute return funds and more hedge funds. And I think given that as Tony has laid out, we're probably at the peak or close to the peak of inflation, and probably at the stage closer to the end of the growth stage of the economic cycle, we're a little bit more cautious on real estate and REITs, and also private equity. And in the commodity side, we are a little bit more selective. So within the commodity complex, we like energy on the back. We think there's a bit of alpha play in there on the back of subdued capital investment and strong demand trends. And as has been laid out by Tony, this can be accessed through the equity side of the portfolio. Now, we talk a little bit more about gold. We like gold for a number of reasons. The main one, obviously, is, as we mentioned, long-term diversification. If you look at over the long term, 10 years, for example, in SGD terms, gold's correlation with global equities is about minus 0.17, and with global fixed income is about 0.16. So very low over the long term. It also, as Tony mentioned, offers inflation protection, as they are real assets and tend to hold their value in an inflationary environment. And there are also upside opportunities on its own, primarily driven by structural change in buying by central banks, driven in part by a desire to diversify holdings beyond US treasuries. I think if you look at the numbers in terms of central bank holdings of gold, the emerging economy central banks, India and China, still have about less than 10% of their reserves in gold, whereas some more developed markets have it, a few times above that. And I think we are also seeing increased some interest in terms of the retail investors, especially, for example, investors in China who are kind of running out of investment options based on what's been happening in recent times. And I think timing is also right for us to look at this gold asset classes with the peaking of interest rates and the US dollars, right? And finally, I think it also gives us a bit of a safe haven asset, given the economic uncertainties, the geopolitical uncertainties, and really the state of the US government financing. And finally, I think talking a little bit about hedge funds, we like hedge funds because we think it's a very good way to access a wide range of uncorrelated alpha sources, which I think adds diversification to the portfolio in this relatively uncertain environment. We do like market neutral hedge funds to be able to capture opportunities. And a simple way of looking at this is we do expect greater dispersion in the performance of underlying companies arising from the higher cost of capital, which will impact different businesses differently. I think, as they say, when in low interest rate environment, the tide is high, you don't see who's swimming without the swimsuit. And when the tide goes down with a high interest rate environment, then you will see more discernment between what you will invest. So I think the short answer is yes, we should definitely look for more diversification in unquoted asset classes in the long term, but even in the shorter term, there are a few of these asset classes that look attractive. Back to you, Jiun Yeh.
Thanks, Han Seng. Maybe just a follow-up question for Han Seng. With gold now above, US dollar 2,000, kind of level, what further upside is there for investor?
I think gold was a strong performer in fourth quarter 23, rebounding strongly from US dollar 1,850 to in excess of 2,000, riding strongly on the twin tailwinds of a retreat of the 10-year Treasury yields and consequent softening of the US dollar. And over the past 4 years, this is now kind of roughly the sixth time that gold is back testing the key psychological level, resistance level of 2,000 US dollar per ounce. We hold a positive view of gold to achieve a sustained move above this level. But it is a volatile market, and it probably makes sense to take the volatility to add to positions.
Okay, thanks, Han Seng. I think with that, well, some of the investment implication for this higher for longer regime is that inflation pressure will remain high and sticky structurally over a prolonged period. Interest rate will trend to stay higher to level that we experienced in the 90s and early 2000 period. And some of the asset classes that likely to perform, real estate like real estate, infrastructure, and REITs, commodities including gold and precious metal, investment grade credit, or even high yield that provide higher yield than your government securities, equities in selective sector like energy, healthcare, infotech, consumer staples, and communication services. What we want to also drive at is that investors need to adopt a more tactical approach in asset allocation, including non-conventional asset classes like commodity, infrastructure, and alternative like hedge fund in this higher for longer kind of investment regime. I think with that, I will conclude our panel discussion. Again, thanks to all the panelists contributing their points of view, they're covering different market, asset allocation, and strategy. With that, I will pass back to Peng Yu.
Thanks, Jiun Yeh. And thanks, Tony, Han Seng, Paul, and Chien, right? Wow, very interesting and insightful points. I think some attractive investment opportunities were raised. We will now go to the Q&A session, but let me start with a question for you, Jiun Yeh, right? Cash, as you've said, cash has done very well this year, right? Depending on the currency, 4 to 5% return, no or little risk, right? As an asset class, right, does cash still make sense in 2024? And does a barbell strategy still work? Jiun Yeh?
Okay. Well, I suppose we all are familiar with this barbell strategy, using cash as an asset class on the very safe, type of assets allocation, and then on the other hand, trying to take risks on some of the risky assets. It probably has done well in 2023, especially in the Asia context. But I think as Tony and Chen was showing, towards the last 2-3 months, the risky assets have started to perform. In fact, if you look at the year-to-date return, cash is starting to lag behind. And then taking our view that interest rate hiking cycle is already done in most of the developed economies, and probably into 2024, whether it's 2 cuts or even more than that, cash is probably not going to be the asset class that you want to park a lot of your monies in 2024. You want your money to work harder to generate return that cover or offsetting a slightly higher inflationary environment. And that will be your equities or some of the diversification of the asset class that we talk about, whether it's your credit or commodities, so that you can generate a higher return rather than still parking in cash, because your reinvestment risk is going to be higher as rate continue to be cut. Back to you, Peng Yu.
Okay, thanks. Thanks, Jiun Yeh. Next question I have for Chien, right? With cash rates, especially Singapore cash rates around 4%, why invest in fixed income?
Thanks, Peng Yu, for the question. I think the answer is actually a fairly straightforward one. I think you can probably expect returns of about twice fixed cash rates in the coming year. For example, you can get that in global high yield, and you could also get it in emerging local currency space. Just to share, I think in the high yield IG space, I think credit spreads would likely be well behaved, as we're not expecting a recession from here. And also, given that the starting yields are now around, say, 8%, of historical analysis, starting as far back as 91 to current, shows that returns would be positive almost 70% of the time with such high starting yields, and that actually the index, the returns could be almost more than 10% in 50% of the time. And of course, from a fundamental perspective, we do see that the debt servicing capacity remains high for global high yield. So I think we do like the global high yield space, excluding Asia real estate, high yield real estate. So that's the case for global high yield. For emerging local currency space, again, we do see yields also again fairly high at about 6 to 8%. And I think one of the reasons is that emerging market central banks have been actually pretty vigilant in their inflation control. And so therefore, their bond yields right now is actually fairly high, 6 to 8%. And I think the other factor coming in this year would be that we do see a dollar being sideways in this time going forward, especially since we'll be expected to cut some rates by, let's say, 2 cuts going forward. And against this backdrop, we do see selected emerging currencies being able to appreciate against the dollar. So in short, there could be potential for FX gains. Overall, I think we do see gains, global high yield emerging market, selected emerging market local currency space to deliver easily about twice the return that you get from cash rates. So I think that's the case for why you want to stay invested in fixed income over cash. Yeah, back to you, Peng Yu.
Well, maybe if I may just add on the emerging market space, I think we want to avoid the weakest link. Your CCC credit, those that are facing, potentially financial distress, given the higher for longer and the higher interest rate, environment that will affect their ability to service their debt. So, like what Chen said, selectively, some of the EM markets and the asset classes are looking actually quite interesting in a kind of weakening kind of US dollar trend. Yeah.
Okay. Thanks, Chen, and thanks, Jiun Yeh. I guess next question, right? There's a question on commodities. Are there any interesting commodities, including edible oils or lithium, copper, that investors can look at in Asia and ASEAN, right? Paul?
Yeah, thanks, Peng Yu. I think that's a very interesting question. Well, the person who asked the question had 3 specific commodities singled out. I'll just comment on these 3 first. Okay, so edible oils, I think some of you might have noticed that actually over the long term, actually edible oils like palm oil, they are quite tied to also soybean oil prices. And this year, I think the harvest for soybean has been pretty good. So you see the soybean oil prices have been coming down, so putting a bit of pressure on palm oil. So I think in the medium to short run, I am not seeing that as the greatest opportunity in terms of supply and demand. So we'll take a look, because I think over the longer term, I do have a pretty positive view on fertilizer prices, and if fertilizer prices, which are tied to, again, natural gas and energy prices, if that goes up, then that's going to put a bit of pressure on edible oils, but not at this moment, right? Because oil price is kind of weak at the moment. I'll leave lithium for the last one. The copper is an easier call. I think for most people who have been following copper, I think the big story is both on demand and supply, right? The demand is that I think you've heard all this energy transition. You're going into EVs. You're going to need a lot more charging stations. And then talk about all this, electricity net that needs to be upgraded in order for this energy transition to go on smoothly. Now, all this basically will result in the commodity, a copper demand that is manifold what the current demand is. In fact, some people say in order for us to reach net zero, we need to mine the same amount of copper that we have mined since humanity has started mining copper. So that's the amount of copper that we need to raise. And obviously, supply is an issue, right? It takes a long time. It takes, as all know, It takes 3, 5, even 10 years to get necessary permits, to dig and to find it. And all these are adding up. And I think over the long term, I think copper certainly does, look very attractive. Now, of course, but we got to temper it a little bit in the short term, because I think that there definitely is a slowdown in terms of manufacturing demand, right? The goods sector is definitely slowing down, hence impacting the demand, short-term demand for copper. But then again, over the longer term, it looks interesting. Now, lithium is a more difficult one. So lithium, again, rides on this EV demand, battery demand. I think we all know that we're going to use a lot more lithium in the future. At this point in time, I think before this EV revolution, I think very few people have actually mined lithium. It's almost worthless. I mean, most of this mine, has this lithium as byproduct, and they almost give it zero value. And suddenly, in the last 2-3 years, people start valuing lithium, and there just hasn't been exploration targeted at the lithium in the last 10-15 years, right? So now people are starting to look at exploration. And I think there are not many big lithium mines for people to invest in, right? So that's something to take note of. And now, of course, in the very short term, I think some of you noticed the lithium. First of all, the lithium stocks itself have come down. You look at the lithium carbonate prices in China, where most of this demand for battery is. They've also dropped almost 70% from last year's peak. I think it's got a little bit to do with the stocking cycle, right? So I think they've overstocked. I think there was a scare that there was going to be a shortage of lithium, I think 1.5 years ago. So a lot of people were stocking up. And then they realized that, they were not going to need as much in the very, very short term. So now I think we are seeing some destocking cycle. But I think, again, once this destocking cycle is over, I think we should look forward to very healthy demand for lithium. But I think that's one caveat. So we have to assume that technology can change every time. So now we don't see it, but I'm starting to hear stories about the world where batteries have no lithium. So then they were on a different, totally different horizon altogether. So I think keep an eye out for this sort of things. But lithium is a bit more of a difficult one. Yeah. Back to you, Peng.
Okay, thanks, Paul.
Yeah.
Paul, I also know that earlier you talked about China. There's also a few questions on Japan. I'll put this to Tony, right?
Yeah.
Japan seems to be seeing inflation for the first time in a very long while. Is this good or bad? What is our house view on Japan? Is it still good to invest in Japanese equities? And how does this higher for longer regime affect Japanese equities, especially small caps? Tony?
Okay, there was a lot there, but I think some interesting comments. So yeah, I think Japan is a really interesting sort of test case for this whole higher for longer issue, because I think, as we all know, Japan has gone through multiple decades of deflation. And I don't think everyone's quite aware how bad this has been for Japan, right? So if you look at their stock markets, like after the collapse in 90, and it fell all the way to reach the bottom in 1992. And if you started investing then and you held for the next 25 years and you counted all your dividends you accumulated over that time, I don't think everyone quite realizes that actually over that total period, your total return was 0%. Even with your dividends, you just didn't make money in a deflationary Japan. And so I think, like the question asked is higher for longer good for Japan? Yeah, I'd say it's actually very interesting that we're seeing inflation at a normalized level, even slightly above normal level for the first time in a long time in Japan. And, I described it earlier. We're positive on global equities in a inflationary environment as long as it doesn't get out of hand. And I think that's confusing to a lot of clients. I usually, feel like I struggle to explain it, but I think the Japan story helps explain it to some degree. Just picture this deflationary environment. You know who did well? I think we all know it's like the retirees. You have your life savings and you just want it to last. And you don't spend too much this year because in 2 years, the prices are going to be even lower. And this creates a world where growth is just very slow and everyone's just hoarding their cash, and nobody takes out loans. Entrepreneurs don't do well in a deflation environment. Nobody takes out a loan because every year the price of what you're selling goes down and your loan effectively just gets bigger in value. So a deflation environment, it's great for retirees and maybe an aging society like Japan, there's a bias towards picking that, but it's not good for growth. It's not good for entrepreneurs. It's not good for the young. And as investors, we like things that grow. We like to invest in things. We like to take out a loan and to see some profits out of it. And I think that's the world that Japan is returning towards. And I think it's quite encouraging. And I think there was an embedded question about smaller caps. I'd say just the other issue with inflation, inflation and higher interest rates mean that your cost of capital is higher, your discount rate is higher, and therefore every investment has a higher burden to make sure it's having good returns. And so hence, I think some of the growth stocks in Asia can benefit. Asia tends to have a bit more growth than the rest of the world. But likewise, small caps in Japan, I think, are an intriguing story. UOB Asset Management, we have a Japan small cap fund, and it's really interesting the types of companies they find. And there's a lot of ingenuity and inventiveness in Japan. There's a lot of small caps that have good growth that I think are going to benefit in this environment. So as I mentioned in our presentation, yeah, we're overweight Japan, and I'm kind of encouraged to what these longer term trends might do to help Japan.
Okay, thanks. Maybe we sort of take a bit of a segue back to alternatives, right? Hansing, you shared about how alternatives helps to add diversification and hence optimize returns for the portfolio. You talked a bit about gold. What about private equity, right? What are your views on private equity investing in 2024?
When we look at alternatives, where the private assets tend to be more return enhancers within the whole scale, right? So you have private equity on the one side, which is really on the risk spectrum, even beyond the small cap space, and then the hedge funds really more on the defensive side of things. At this point, we have been cautious. To be frank, not only at this point, we've been really cautious as we envisage the higher for longer and interest rate rising environment. We've been cautious on private equity, primarily because we've been through really what I call a golden era for private equity, where interest rates have been just declining. Right, it's been low and it's been declining and it's low, which is great for many segments of the private equity space. In the buyout, you can refinance and return capital at lower and lower rates, and lower interest rates also allow many of the venture companies to get funding at a very low rate and increases their kind of runway. At the higher interest rates where they have to refinance, and obviously the runway for many of these companies will slow down, and then the question is who can survive in this kind of environment. So a mixture of that interest rates are higher, economic conditions are a little bit softer than before. There is the uncertainty of regime change, and that could favor certain industries which have been exciting in the past, may not be in the future, and we need to figure out what is interesting going forward. Combined with the fact that a lot of money has been raised in this space, and a lot of new investors are in this space, and also in this environment, the exit environment is also not very easy in many places. So I think bottom line is we think that the timing is probably not right for private equity at this point. Having said that, we do note that there's a lot of interest in private credit. And the whole story is that obviously the returns there are much higher today as we've transitioned between TINA and TARA, and everything kind of works well. Our view is that it's interesting, but I think a lot of the concerns we have on the private space is also applicable to private credit, and a lot of money is running in there, and given the state of the economy and what's going around, we are not particularly enthusiastic about that in general, but we do recognize that if you want to go there and you can be selective and you can find people who can generate for you money and look for these opportunities, it is great, but we're not particularly enthusiastic about that. And we feel that as Chen has mentioned, you can get quite good opportunity, you can get quite good returns in credit without really going too far off the extremities of the credit profile. So we prefer to stay within the high yield if you really want to get high returns in credit. Back to you, Benyu.
Okay, good. Thanks, Ansing. So be a bit cautious on private equity, but private credit looks more interesting. Okay, I would like to circle back with, we've got a few questions on high yield, right? So back to you, Chen, right? Asian high yield, is it too high? Is the risk too high to invest in 2024? Do you prefer Asian high yield compared to global high yield? And you mentioned previously about high yield bonds yielding 8 to 10%, right? Is that from a fund perspective, a portfolio perspective, or a single issue? And I think there were also other questions about, the high yield space. Is it higher risk? Obviously, it's higher risk, right? But given that interest rates are higher for longer, right? Is this going to eventually impact corporates, right, who are stressed due to the cost of their borrowings?
Thanks, Bayu, for the question. Let me address them one by one. Starting off with Asia high yield first, I think this is a discussion that has been ongoing within the firm for quite a while now, coming close to, I think, 2 years since the Evergrande episode started. I think overall, I think indeed we remain cautious, underweight on China real estate, given that we do see structural deleveraging still playing through as they move towards more sustainable growth engines towards the consumer and less on the real estate. But I would say that against a backdrop of that, there are indeed actually still fairly good opportunities outside of China real estate. So I think, in short, we as a firm, we do like Asia high yield, just excluding the China real estate portion. That's why that's the overall message that we want to send. The other question, I think, on global versus Asia, I think indeed, I think it's a good question as well. I think why I would favor global over Asia is because the sectoral composition of global high yield tends to be more diversified, whereas, for example, Asia high yield would clearly be concentrated more on the real estate and certain of the commodity sectors. So I think the global high yield space tends to be more diversified, and therefore that would benefit, investors would benefit from more diversified exposures from there. Yeah, and then finally, I think on the question on the yields getting about 8-9%, indeed, this would be what you get from high yield bonds, bond funds. They are pretty much the same. Basically, fund is a collection of bonds. So depending on your fund, is it weighted towards more higher quality high yield or lower quality high yield? The yield would be different. But in short, I think basically the high yield bond funds does yield around 8%. Even the emerging local currency space, the bond funds also around that ballpark. Of course, we may not want to just buy into an index. We want to be selective, as what Jiun Yeh shared. I think we want to be invested into, for example, where the fundamentals remain healthy and strong. And I think on that point, coming back to your point, we do note that the interest expense for corporates that may weigh on a higher for longer environment. I think right now, indeed, looking at the maturity or refinancing profile, I think some of the bonds will need to be refinanced, I think, next year. But again, I think given how rates have somewhat come down as well, I think this is unlikely to pose like a big headwind for the debt servicing requirements from here. Yep. Back to you, Ping.
Okay, thanks, Paul. Thanks, Chen. Next question, we have a few questions on the US dollar. The direction of the US dollar, but I'd like to focus it a bit more on the impact on Asian equities, right? So, Paul, what's our view on the US, US dollar, Sing dollar relationship? But more particularly, right, what is a weak US dollar? How does it bode for Asian equities, right? Is it positive or negative? And then more specifically, there is a significant tech supply chain that we are seeing and growing in particularly markets like Taiwan, Korea, as well as China, right? What will a weaker US dollar impact on these sectors?
Thanks, Ping, for the question. I think in general, I believe our house view is that the US dollar over the longer term would be, holding up, maybe weaker for a while, but it won't be too weak, right? a weaker US dollar actually is not so positive in general for exporting economies or exporting countries. So that includes some of the tech companies you've mentioned, right, in Taiwan, because they're earning in US dollars. So in general, it's not that positive for these companies. I think there are a couple of other tech questions that people are quite interested in. I saw. Maybe I'll take the liberty to just answer some of them. I think there was a question on whether how the tech sector would fare in this higher for longer regime. So my take is this: I think I think there will not be that much of a negative impact. Yeah, yes, the funding costs. I think like what Tony's mentioned. I think funding costs for most companies, right, including tech companies, would have increased. But we know that in the last cycle, especially, a lot of tech companies have actually been making a lot of money, so their margins are pretty high, and that's because the industry structure has actually improved over the last couple of years. Take DRAMs, for instance, right? It used to be a very fragmented industry. Now it's very, very concentrated. And a lot of companies are making lots of money. So then they have high pricing power, and that's more important, right? I mean, to Tony's earlier point in the presentation, I think he mentioned that companies that have pricing power, they will tend to do quite well in this environment. I think there was also a question on the other AI companies, how they're going to do. So it's the same thing, right? So I think over the longer term, I think we see that there's just going to be more demand for semiconductor, not less, right? Because, I think in the next 5-10 years, we're definitely expecting more demand for computing power. In fact, now with the EVs, these EVs have been described as computers on wheels or servers on wheels, right? So there's a lot more computing going on, even in the normal vehicle, from dumb vehicle to smart vehicle now, right? So and then you're gonna have smart fridges, I don't know, smart anything else, right? So there's definitely going to be a lot more demand for semiconductors. Yes, I think some of the weaker ones will be weeded out by higher rates, but most of them are highly profitable, and they'll continue to do very well. So I think I hold a very positive view for tech semiconductor in general over the cycle. Like I said, I think we in the last 1.5 years we've gone to a down cycle in tech, and yet unlike in the past, many of these companies have not gone to losses. In fact, they're still making record profit. So as the general economic conditions turn up, I think they'll do even better. So I think positive view on tech, semiconductor, and such, even in this higher for longer environment. Back to you, Peng Yu.
Okay. Thanks, Paul. Still interesting opportunities out there. Maybe I take this. Let's move back to this more global macro sort of question, right? There are questions about geopolitical issues. Obviously, they are there, right? 2022, 2023 particularly have been beset by these issues, right? Tony, for global equities and say US equities, right, with all these issues still affecting and impacting the markets, right, are there any sectors we should focus on? And I guess not just China and US, you've got China, Taiwan, Hamas, Israel, and obviously the ongoing Russia-Ukraine war, right? What can investors do, right? What are some of the measures they can take to reduce the volatility?
Yep, good question. Obviously, I think, we had a fairly constructive outlook for 2024, but it is fair to note that there are a lot of risks out there. The geopolitical risks in particular are more complicated than we've seen in a long time. I would say that, fund houses like us, we're constantly evaluating these. We've been updating both in presentations and our written documents that go on our website and all. We've been updating on the Middle East and how we're thinking about it and how we're balancing these risks. You asked about, how to invest and where to invest. I think it's true that, especially like our analysts and stock pickers that are, building portfolios, there are repercussions. There's interesting opportunities. There's defense companies that are seeing bigger spending, that countries around the world are spending more on defense than we've seen in a long time. We're seeing a lot of the tensions between the US and China create both losses and opportunities. And I think our analysts really have to be on the ground. And I guess as investors, you should trust fund managers, whether it's us or others, to be on top of this sort of stuff. The last comment I would make about just investing is, I think it speaks to like one of the themes we've been harping on. I feel like a lot of the clients I speak to have just been hiding in cash for the last couple of years, and I understand why. But questions like this speak to why diversification is important. If in fact, the Middle East gets much worse, then that's going to have economic consequences. It's going to lead to interest rate cuts. It's going to hurt your cash rates, and other asset classes will do better. And hence, your broader portfolios and giving analysts to stock pick, I think, are some of the things that investors should be doing in this complicated world.
Okay, thanks, Tony. I guess I'll just try to run through a few questions as we come to the close of our session. There are a few questions on REITs, right? So I'll go back to Paul. REITs obviously have underperformed this year. So how do we see the prospects for REITs next year? And whether it's US commercial REITs, China property market, how does this play, right, in our view for REIT investing, how our approach towards REIT investing?
Yeah, thanks, Ben. You did this like a question on all the issues in the universe happening at the same time. So it's a very big question. Okay, let me try to take it one by one. Singapore REITs, I think obviously, last year, as you just mentioned, it's done very badly. I think one of the main reasons, of course, are rates, right? Because rates were going higher. And then hence, the prices for, or the performance of Singapore REITs, or REITs in general, has not done very well. I think if you've been listening through this session, I think Tony has hinted that we believe that the rate situation has peaked, right? So we believe there are two cuts. Of course, like what Tony mentioned, there are people who believe that there are going to be more cuts next year. So that, all else being equal, is going to be positive, right, for Singapore REITs and for REITs in general. Now, I think the US commercial real estate, that's a different kettle of fish altogether. I mean, I'm no expert in the US commercial real estate, but from what I've read, there are some serious liquidity issues, financing issues. In fact, there are quite a few, retail operations, big chains, they are closing down. And that's not going to be good in general for US commercial real estate. But again, we don't really invest there for our REITs fund, so we don't have very specific comments on that. But I would think that this is not a low risk investment at this point. So do take note of that. On the China property real estate, okay, so our view is that at this point we're very cautious. So obviously, this thing has been brewing for decades, right? It hasn't just happened, and it's a very big problem. The government has had many attempts to try to resolve this issue in the last couple of years. Suffice to say that the market isn't convinced that this is the silver bullet that can solve the problem. So even today, or in the last couple of days, we've heard the government announcing even more measures on the liquidity, easing the liquidity to help tide over some of these troubled property developers. But I think it's an ongoing saga. We're watching that very carefully. But at this point in time, I would say we're still very cautious on that. Yeah, back to you, Benny.
Okay. Thanks, Paul. I just end this with a final question with Tony, right, from a big picture perspective, right? There were, I guess, double-digit, interest rates in the late 1970s, right? Why are we not expecting to see it now? Is there room for interest rates to go even higher? And how are we different, right? We're looking for 2 cuts next year. How are we different in terms of interest rates cut by the US Fed in 2024? And when do we expect these cuts to happen?
Okay, yeah. So, I mean, the comparison to the 70s is complicated. And, even economists who break this down, there'll be lots of disagreement. But I think, typically the answers boil down to that structurally prices were less anchored. And in particular, the whole wage structure, and especially the developed markets, that had more sort of union structures that were automatically tied to higher inflation would trigger higher wages, which would trigger more inflation, et cetera. And then, it started with energy prices spiking, and the whole economy was kind of geared towards leading to runaway inflation. A lot of things have changed since then, and hence, it is our view that we see enough differences that we don't think it's easy to repeat the 70s, but at the same time, I don't mean to be overly complacent in expressing that we don't worry about it at all. We actually spend a lot of time thinking about it, even though our message in the end is we don't think that's the direction we're going. I think the last part of your question is just where do we stand as far as being different in terms of our outlook for next year? Yeah, we do expect rate cuts, and I think that's quickly become consensus. Everybody's expecting that now. I would say that I think we've been highlighting, a firmer view on this throughout, especially second half of last year, when I felt like central bankers were still sort of repeating, inflation's out of control and we have to do more rate hikes. We were saying, actually, we don't see it. The inflation numbers are really trending in a good direction. We think they're pretty much at the end. And so now the question is about the rate cuts. And so we're more modest on our expectation for rate cuts than the market. So I'd say the number that we have is 2, and the number the market has is 5 rate cuts next year. And I think the market's getting ahead of itself a bit. I would say that historically, if you're not going into a recession, we've seen a few periods like this, such as 1995 and maybe 1998, where the expansion continued and the Fed moderated interest rates a little bit after fighting inflation for a bit. But they only did it gradually with only a couple rate cuts. And then they kind of hold the interest rates through the end of the cycle. And I think that's more the outlook that we're expecting. And I think if we're wrong, it's probably because the economy is slow more than we're expecting. But based on what we're seeing now, I would sort of temper expectations, not to get too aggressive on the rate cut expectations.
Okay, thanks, Tony. Well, 90 minutes sure passed quickly, right? We've run out of time, so we'll end the Q&A here. Thanks everyone for your thoughtful questions, and we hope you found this webinar stimulating, insightful and useful as well, right? Thanks Jiun Yeh, Tony, Han Seng, Paul, and Chen for participating. For the audience, we urge you to download the Higher for Longer white paper. There's so many terms, right, related to inflation. There's stagflation, deflation, disinflation, and of course, this term that we use quite a bit today, higher for longer, right? And a lot of misunderstanding as well, right? So this white paper helps to explain what these are and provides actually some useful tips on what you, right, the investors, should do to avoid these pitfalls and get the most from your investment opportunities in the next few years, right? So just scan the QR code that's on the screen right now. And finally, as always, UOBAM, the team is here to help you and answer any further questions you may have, whether this is on our near-term market outlook or our longer-term structural view, right? And as you know, we have analysts all across Asia. If you want to find out about Asia or ASEAN, which we know that's our key focus, or any specific local market, right? Of course, we have a wide range of investment funds and solutions for you as well. So to help you, our clients, benefit from the upcoming rate cuts, but still relatively high inflation, environment, please reach out to us by contacting your relationship manager. Again, thanks for joining us today. Enjoy your year-end festivities and all the best for investing in 2024. Thank you, everyone, and see you again soon.